Sajid Chinoy, India economist with JP Morgan, joins us. Sajid, good morning. Thank you for joining us. Sajid, yes, the core fundamentals and the macros for Indian economy are looking bad, but Indian currency has fallen 10% in the month of August. That makes it the worst performing currency in the world. Obviously, our macros are not that bad that a currency warrants a 10% fall.
No, absolutely. I think most estimates of the fair value of the rupee will be somewhere between 59 and 60. So we've clearly overshot, and the rupee is clearly undervalued. I think that needs to be clear because a lot of estimates being put out that the fair value has moved to 64, 65. We're certainly not in that camp. Inflation is high, growth has fallen, but whatever measure of the real effective exchange rate you use, India's fair value is still in the 59-60 range. I think what's happened is we've got into a classic self-fulfilling vicious cycle where currency weakness is driving more weakness. No exporter wants to sell, the market's extremely illiquid, oil importers have to buy, and that pushes the rupee even weaker and validates those expectations. The other worry for me is over the last week we've begun to see equity outflows. The debt outflows were understandable. It happened around the world, in all emerging markets, given the repricing of debt and the rise in US interest rates. The worry is equity is a much larger stock in the Indian market. Total FII equity flows, the stock is about 160 billion. And that has now begun to leave, and that has also become a vicious cycle. Equity is leaving because the currency is weak. Because equity is leaving, the currency weakens even further, and you get stuck in the spiral. So I think what's really critical in the short run is somehow for policymakers to draw a line in the sand, somehow to stabilize the exchange rate for a week or two to try and break this cycle.
Sajid, hi, how serious then are the geopolitical risks right now in Syria, because that has really led to a collapse even in the global markets? And do you see oil and gold prices spiking sharply? Because a high crude price and a weaker currency is double trouble for India.
Absolutely. I mean, let's not ignore the fact that this is all happening against the backdrop of a very challenging global environment. India is not the only currency to suffer. Yes, we are by far the worst, but India's fallen close to 18%. Brazil is, despite massive FX intervention, is down 16%. Indonesia, which has a much lower current account deficit, is down 14%. So the pickup in US interest rates, what people expect from the FOMC, and more recently the geopolitical risks that you mentioned, really are a body blow, because commodities will rise and flows to emerging markets will abate, and that means very complicated macro management for commodity importers like India.
Sajid, so what could be that turning point? Because there has to be a turning point. There will be a turning point when rupee will become competitive, imports will start falling, exports will start picking up. The problem is, how does one figure that turning point?
Right. If you look for a turning point in terms of actual macroeconomic variables, they take time. We've seen there is a J curve. So the rupee first has to stabilize at some level for Indian exporters to get the benefit of this real depreciation. It has to stabilize at some level for importers to stop front-loading their imports. So I think the turnaround in terms of the real economy will take time. At this point, what we need is a turnaround in expectations. I mean, clearly, as I mentioned before, the rupee is now greatly undervalued, about 10-11%. So either you need, FX intervention, which is stronger by the RBI. I've never been in favor of, large FX intervention because the efficacy of that is under question. But in an environment where you've got a very illiquid market and a classic self-fulfilling vicious spiral, I think some FX intervention, sustained intervention to draw a line in the sand could begin to change expectations, A. B, there have to be the right policy signals from Delhi. I think the finance minister hit all the right notes yesterday. But if you see, a large diesel price hike or something to that effect to convince market participants that, the government's still carrying on with its fiscal consolidation, with its current account deficit compression, with reform, that could also constitute a turning point. So I think a combination of what the central bank does and what the government does over the next week or two will be very crucial.
Sajid, just want to bring a point. The sell-off has been really sort of huge ever since Tuesday. That is the night after the food security bill got passed. How damaging is that, A, for the inflation and B, for the current account deficit, and thereby, sort of worsening the currency picture and any hope of a rate easing?
I'm not in the camp that really was the turning point. The currency has been under great pressure for the last 2 weeks. The food security is already an ordinance. There were widespread expectations it was going to become a law. So I think it came as no surprise to a market, and I think that's more of a, ex post facto, after the fact justification. Clearly, it's not helpful, and I think in the medium term, I want to make the point, nobody really grudges food security. It's really a moral imperative for any developing country. The only issue is going to be design. Does it reach the people it's intended to? What is the scope of leakages, and what will be the eventual fiscal cost? I don't think that's really what's at the top of the market's mind, because the fiscal cost for this year is not going to be as high as people make it out to be. The much bigger worry is for the fiscal deficit is what happens to tax collections because growth is slower than budgeted, what happens to oil and fertilizer subsidy. I think those are the bigger worries. And I just want to go back to, I haven't given up hope. I want to go back to September of 2012. Exactly at this year, this time last year, we were grappling with the same kind of problems. The exchange rate was not on a free fall, but the fiscal deficit was in course of significant slippage. There was a very real threat of a ratings downgrade. Growth had begun to slow, and policymakers showed very strong resolve in the month of September to try and address these issues. I think we'll need to see similar resolve this September as well.
Sajid, do you think the big turning point, like we were discussing, for Indian economy or Indian currency will come from US? The minute poor economic data starts coming out from US, maybe rupee will stabilize, because the core of the outflow here is that developed market economies are doing well, money will be pulled out of emerging markets. But once markets realize that developed market economies and US economy is not recovered, maybe this outflow will start winning away.
That may be true, but I don't think policymakers in India can plan their policy hoping for bad data or soft data from the US. The FOMC is still 3 weeks away, and there's too much time between now and then, A. B, I think there are two factors driving the rupee weakness. One clearly is global factors, as we've discussed. So any change on that front will be helpful to all emerging markets in India. But B, I think there's an issue at home, which is that the currency market in particular has got into a vicious self-fulfilling spiral. So if that spiral can be broken and the signal can be sent, I think you can get some mean reversion here relatively quickly and relatively sharply, even without relying on soft US data. I think we have to realize that even if tapering doesn't start in September, even though that's our baseline case, it's going to happen at some point. It's going to happen in December. So we can't be hoping and wishing that the global economy does worse. We have to fix our own problems at home to ensure that the impact on India is minimized.